Most traders lose money because they chase breakouts that aren't real. But what if I told you there's a simple way to spot the trap before it happens? In this video, I'm going to show you the Candle Range Theory, a strategy that reveals exactly how smart money manipulates the market and how you can trade alongside them instead of against them. In this video, you're going to learn Candle Range Theory basics, the power of three connection, the main CRT patterns, time frame analysis with CRT, real chart examples to show you exactly how to trade in the market, a strategy that works across Forex, cryptos, stocks, and commodities, and one you can apply to scalping, day trading, and swing trading. Candle Range Theory, or CRT, is built on a simple but powerful principle. Every single candlestick on your chart is more than just a shape. It represents a complete range of price action. Think about it this way. When you look at a candle on a higher time frame, that candle reflects the overall movement of the market during that period. But when you zoom into a lower time frame, you'll see the smaller micro movements that actually created that candle. Here's the key. Every candle has a high and a low. These 2 points define its price range, and when you break that range down on smaller time frames, you'll uncover the structure, liquidity, and hidden battles between buyers and sellers happening inside that single candle. That's the foundation of Candle Range Theory, using one candle as a window into the true story of the market. In every market, price doesn't move randomly. It follows a repeating cycle that can be broken down into 3 key phases: accumulation, manipulation, and distribution. Together, these phases are known as the power of 3. And if you want to trade Candle Range Theory successfully, you must understand this structure. So what is the power of 3? It's a smart money concept that explains how institutional traders, the real movers of the market, position themselves before launching a big move. Let's break it down. Consolidation. This is where smart money builds positions. Price moves sideways, trapped inside a tight range. To most retail traders, it looks boring or directionless, but in reality, this is where the groundwork for the next big move is laid. Think of it as the calm before the storm. Manipulation. This is where things get interesting. The market suddenly fakes a breakout, either above resistance or below support, to trap retail traders. This move isn't real. It's designed to grab liquidity and trigger stop losses. We call this a liquidity sweep. The purpose? To shake weak traders out of the market and collect their orders before the real move begins. A liquidity sweep happens when price breaks below a well-defined support level, but instead of continuing lower, it quickly snaps back into the consolidation range. At first glance, it looks like a real breakout. Retail traders rush in, thinking the market is finally moving, while others get stopped out as their protective stop-loss orders are triggered. But in reality, this is a false breakout engineered by smart money. The goal is simple: grab liquidity. Here's the psychology behind it. Retail breakout sellers believe the market is about to crash, so they enter short positions. Traders holding long positions get stopped out, as their stops sit just below support. Smart money uses this pool of liquidity to fill their own positions at the best possible price. Once that liquidity is captured, the market reveals its true intention. Price usually explodes in the opposite direction. This is called the acceleration phase, the powerful move that follows the trap. As smart money traders, our objective is clear. We don't chase the breakout. Instead, we position ourselves to ride the acceleration phase, using the liquidity grab as confirmation that the market has just cleared the path for the real move. The acceleration phase is the explosive move that follows a liquidity sweep. Once smart money has triggered stop losses and collected liquidity, price no longer has obstacles in its way. With retail traders trapped on the wrong side, the market is free to move aggressively in the opposite direction. Here's what happens step by step. Stops are cleared, long traders are forced out, and breakout sellers jump in late. Liquidity is transferred. Smart money takes the other side of those trades, building positions at discount prices. Momentum kicks in. With liquidity secured, institutions drive the market strongly in the intended direction. This surge creates the acceleration phase, the sharp, decisive move where the real profit potential lies. As smart money traders, this is the moment we want to capitalize on. Instead of being trapped by the false breakout, we align with the acceleration, entering trades immediately after the liquidity sweep. By doing so, we ride the momentum created by institutional actions, turning the trap into our opportunity. Now you might be asking, how does Candle Range Theory connect with the power of 3? Here's where it all comes together, and once you see it, you'll never look at a candlestick the same way again. Candle range theory works as your leading indicator on the higher time frame. That single candle, with its high and its low, sets the range where the game will be played. But inside that same candle, on a lower time frame, the power of 3 is unfolding step by step. Think of it like this. The first candle in CRT defines the high and low. This is the accumulation phase on the lower time frame. Price is consolidating, smart money is building positions, and liquidity is stacking at both ends of the range. The second CRT candle often fakes a breakout beyond that range. This is the manipulation phase on the lower time frame. It's the liquidity sweep. Stops are triggered, retail breakout traders get trapped, and smart money collects orders. The third CRT candle is the breakout with conviction. This is the acceleration or distribution phase on the lower time frame. Price finally takes off in the real direction, leaving retail behind and rewarding those who waited for the setup. So here is the golden connection. One higher time frame candle equals the entire power of 3 cycle on the lower time frame. When you understand this, CRT stops being just a theory. It becomes a roadmap that shows you exactly where smart money is accumulating, where they're manipulating, and where they're accelerating the market. Alright, let's jump into a real chart example so you can actually see how candle range theory and the power of 3 play out together. We're looking at the Euro, US dollar on the 1 hour chart. So here's our first range candle. We're going to draw a line at the highest point and another line at the lowest point. That gives us our CRT range. Simple as that. Now check this out. The very next candle breaks below the low, but look, it actually closes back inside the range. That's huge. On the higher time frame, this is our first clue that manipulation just happened. Now let's zoom into the 15-minute chart and see what was really going on inside that 1 hour candle. First, we had a period of accumulation. Price moving sideways, building orders, nothing too exciting. This is the setup stage. Then comes the manipulation. Price sweeps below the range, takes out stop losses sitting under support, and then snaps right back inside. Classic liquidity grab. So think about what just happened. On the 1 hour chart, that second candle looked like just a false breakout. But on the 15-minute chart, you can clearly see the power of 3 cycle, accumulation, manipulation, and acceleration. Now let's talk about how you'd actually trade this. Here's the play. Entry. After the candle closes back inside the range, that's your confirmation the sweep is over. Stop loss. Just below the wick of that liquidity sweep. Target. The high of the 1 hour range, which now acts as resistance. And look what happens next. Price rockets up and hits the target beautifully. Clean and simple. So this is just one example to show you how candle range theory works hand in hand with the power of 3, and how together they can give us a really powerful trading setup. Of course, the market won't look this clean every single time, but the principle stays the same. Once you learn to read a higher time frame candle as a roadmap and then zoom in to see the power of 3 on the lower time frame, you'll start spotting these setups again and again. Alright, now let's shift gears and talk about the different types of candle range theory patterns. First up, the classic 3-candle CRT pattern. This is the foundation, and you'll see it again and again on every time frame. Candle 1 sets the stage. It defines the high and low of the market for that range. Think of it as the map. Candle 2 is where smart money gets sneaky. This is the manipulation phase, a false breakout above or below the range designed to trap traders and grab liquidity. Candle 3 gives you the confirmation. It closes back inside the range, or even above it if it's bullish, showing you the market has rejected the trap and is ready for the real move. Here's the beauty of this pattern. When you spot it on a higher time frame, you don't get caught chasing false breakouts. Instead, you wait for the manipulation to play out, and then you ride the acceleration with smart money. Next is the inside bar CRT pattern. This happens when one candle forms completely inside the range of the previous candle. What does this mean? Indecision. The market is pausing, building energy, waiting for the next move. But smart money is watching closely, and so should you. When price makes a false breakout of that inside bar, either above or below, that's your clue. The breakout is the manipulation, the snapback is your signal. Once the reversal kicks in, you've got a perfect entry to catch the sharp move in the opposite direction. Finally, let's talk about the multi-candle range expansion pattern. This one is different because instead of just 3 candles, the market takes its time, stacking multiple candles into a bigger, stronger range. The longer it takes, the more powerful the setup becomes. Why? Because smart money is quietly building positions and sucking in liquidity from both sides. Here's what you look for. Multiple candles that wick above the high or below the low of that range. Each wick is a liquidity grab, and when the real breakout finally comes, the move is explosive, often much stronger than the standard 3-candle setup. That's your moment to step in and ride the momentum. One of the biggest keys to trading candle range theory with precision is time frame alignment. If you nail this, your entries feel sharp and controlled. If you miss it, you'll constantly feel late to the move or shaken out by noise. So let's break this down step by step. Here's the golden rule. Whenever you identify a CRT setup on a higher time frame, you should always confirm and refine your entry on a lower one. So if the setup appears on the daily chart, the natural execution window is the 1-hour chart. Why? Because on the hourly, you can actually see how the market builds inside that daily candle. You'll catch the consolidation, the sweep, and the expansion in real time. That's where your precise entries and exits come from. Now, let's say you've spotted a CRT on the 4-hour chart. The best time frame to refine entries is the 30-minute chart. A lot of people suggest the 15-minute here, but after extensive testing across thousands of examples, the 30-minute proves to be more reliable. It strips out unnecessary noise, but still gives you the clarity you need for execution. For a CRT on the 1-hour chart, your lower time frame is the 15-minute. That combination works smoothly because it keeps your analysis structured while still giving you enough detail to find high-quality entries. Some traders prefer the 5-minute, but the truth is, it often tricks you into overtrading. Stick with the 15-minute for consistency. And finally, if you're analyzing a CRT on the 15-minute chart, then yes, you can drop down to the 1-minute time frame for quick scalps. But let me warn you, this is advanced territory. The lower you go, the more discipline and tight risk management you'll need. Don't rush into scalping before you've mastered the higher time frame setups. Alright traders, let's walk through a real chart example so you can see exactly how candle range theory plays out in live markets. We're looking at the Australian dollar against the Canadian dollar on the 1-hour chart. So here's what we've got. The market is trending upward, and then we get this range candle. We mark the swing high and the swing low. Those are now our key levels, acting as resistance at the top and support at the bottom. From here, it's all about waiting to see what price does around those boundaries. Now look at what happens next. The very next candle breaks above the swing high, but here's the trick. It actually closes back inside the range. That's not just a random move. That's a buy-side liquidity sweep. What does that mean? Smart money just ran the stops of traders who went long on the breakout, collected their liquidity, and then pushed price back inside the range. And when that happens, it's a strong clue that the market could reverse lower, at least down to retest the hourly support level. Alright, now let's zoom into the 15-minute chart, which is our execution time frame when working with the 1-hour CRT. And here it is. The market was trending up, it poked above that hourly resistance level, and then it closed back below it. That's a crystal clear liquidity sweep on the lower time frame, and it often signals the end of an uptrend and the beginning of a new downtrend. Now, here's the level we're interested in, the hourly support. Based on CRT, the market is very likely to retest this level. That's our trade idea. So here's how you'd execute it. Entry, at the close of the candle that confirms the sweep. Stop loss, just above the resistance we broke and rejected. Target, the hourly support level below. And look at what happens next. Price slides straight down into our target, delivering a clean 2-to-1 reward-to-risk ratio. That's the power of candle range theory in action. It gives you a simple framework to spot manipulation and align yourself with the real move. So next time you see a candle sweep one side of the range and close back inside, remember this. Smart money just showed their hand. Your job is to wait, confirm it on the lower time frame, and then ride the move in the opposite direction. Alright traders, let's switch gears and look at a scalping example using candle range theory. This time we're on the British pound against the US dollar 15-minute chart. So here's the setup. We spot this big candle that becomes our CRT candle. We draw the swing high and swing low. Those are now our key levels. The swing high is resistance, the swing low is support. Simple and clear. Now watch closely. Price breaks below the support, the swing low, but instead of continuing lower, it closes back inside the range. That right there is a sell-side liquidity sweep. What does it mean? It means smart money just grabbed liquidity from traders who went short on the breakout. And once that liquidity is collected, the market is more likely to push higher, at least to retest the resistance at the swing high. Alright, now let's zoom in to the 1-minute chart, which is our execution time frame for this 15-minute setup. And look at this. The market also broke below that same level and then snapped right back inside. Another sell-side liquidity sweep. When you see the same signal repeating across time frames, that's your confirmation. The market is telling you, I've cleared the liquidity, now I'm ready to go higher. So here's how we trade it. Entry, at the close of the 1-minute candle that re-enters the range. Stop loss, just below the sweep wick. Target, the 15-minute resistance level, the high of the CRT candle. Now, here's the key. The strategy is simple and it works beautifully, but it's not a holy grail. Always use a stop loss. Protect your money because no strategy wins 100% of the time. But when you combine CRT with proper risk management, even a single good scalp like this can give you an excellent reward to risk trade. If you found value in this video, make sure you hit the like button, subscribe, and turn on the bell so you never miss the next strategy breakdown. And let me know in the comments, do you plan to use CRT for scalping, day trading, or swing trading? I'd love to hear from you. Thank you for watching and see you in the next video.